Hey, what's going on? So today on Market Structure Basics 101, I'm going to be teaching you guys of fair value gaps and how to actually use them in the market and what they look like and what they are. If you are a new trader, I got a playlist on my YouTube page that explains the market structure basics, helping you build the foundation for you to be a profitable trader. So I really recommend you check out my YouTube channel, subscribe, check out that playlist because there's a lot of golden nuggets in that playlist. Also, join the free Discord. It's absolutely free. I live stream every single day, every single morning. I'm in there, I'm trading, and I'm sending out free signal trades to the Discord. I'm communicating with the community. It's just a good place to hang out with other traders. Okay, so the link is going to be in the description for that. So fair value gaps. So fair value gap is basically an imbalance or an inefficiency in the market. So what does that mean? It means that in order for you to move the market, you need a lot of money. You need a lot of money that you buy into or you short into. So usually the big players that can actually make these markets move are the big corporations, the big banks who are making these, deposits or these purchases that are moving the market. And when there's a large amount of money coming into the market, it can create a demand or supplier demand push, right? And within these supply and demand pushes, it leaves inefficiencies or imbalances. So basically what it means is, like in this instance, for a bullish demand setup with an imbalance, a fair value gap, is there has been a lot of buying pressure and so much buying pressure that it has left an imbalance in the market by leaving a gap behind. So as you can see, a fair value gap is going to be always created with three candles, the three candlestick pattern basically. And it starts with the beginning candle, the middle one, and then the push. And if you see, look at the wicks. If you on a bullish demand, if you draw a line at the top of the beginning green candle and at the bottom of the last or the third green candle, there's this huge gap that has been left behind. Okay, the market always leaves gaps in the market or inefficiencies or it's just basically gaps that it leaves because there's so much buying pressure that it leaves just an inefficiency in the market that needs to be created and at some point needs to be filled. No matter what, the gap in the market will always be filled. What does that mean? That means that at some point there's going to be a candlestick that completely closes this gap, correcting the inefficiency in the market. Okay, hopefully that doesn't confuse you. So what I'm going to do is I'm going to show you what I mean. Okay, so as you can see here, this is for a bearish example. We have a three candlestick formation indicating that there's a lot of supply pressure, a lot of bearish pressure coming from this area. If you haven't watched my support and resistance and how to identify key areas, make sure you go on to the Market Basics 101 and watch that video, because that video is going to help you identify key areas in the market on the higher time frame in order for you to be prepared to enter and trade the market basically. So watch that video and then come back to this one. Once you identified your key area, so this area is my key supply area. What I want to do is I want to wait for price to give me a reaction from this area by a three candle formation pushing to the downside and leaving an inefficiency, also known as a fair value gap. So let me show you. If you can see here, we have a retest to our area of interest, and then we're starting to get this push to the downside. We have three long engulfing bearish candles, and it leaves an inefficiency between the first candle and the third candle. As you can see, we draw a line from the first candle bottom wick, because this is a bearish supply setup, and we're going to draw another line on the third candle at the top, which leaves us this huge imbalance in the market. No matter what, this imbalance will always be filled. Candlesticks will always go in here to correct this imbalance. So now you have to learn the basic market structure of and your bias for that day. Okay, so before you even learn about these entry confirmations, because this is an entry confirmation setup and how to actually enter into the market, it's very important that you watch the playlist, the market structure basics, because that will help you identify key zones where you will be interested in entering a trade, as well as identifying the market direction of the trend, because you do not want to trade against the trend. You always want to trade with the trend. So in this scenario that I'm showing you here, I have already identified my key area, which is this supply area up here, and I have already identified the direction of the trend, which will be a bearish trend. So I'm waiting for price to retest this area, and from this area, this is where we get onto the video. I'm looking for some kind of reaction, which we just got here. Okay, we left a huge imbalance. All right, the next thing that I'm looking for is a break of structure, which again, I talk about what a break of structure is on the market structure basics videos. So as you can see here, we had a huge break of structure right here, indicating that price wants to continue pushing to the downside. So now our actual entry confirmation is we have a tap into our supply area, our area of interest. We have a nice reaction or rejection from this area, leaving an inefficiency, which is a fair value gap, here is a huge gap, along with the break of structure. Once you have all those confirmations, then you can look into entering a trade. So what I like to do is I like to draw a box from these lines that we just drew up. And it's important that you go onto this cogwheel, go onto the style, and then hit this middle line, so that way you get this dotted middle line here. What you want to do is, this is your area where you're going to be entering to short the market. Preferably, you want to enter at this 50% line of the imbalance, inefficiency, or fair value gap. This is going to be your best entry point for where you're entering the market. What you want to do is you want to place your stops above the swing high. Okay, above the swing high of the first candle that created the push to the downside. So as you can see, this is the first candle, and I'm putting my stops above that swing high of that candle there. I'm entering at the 50% line of this imbalance or fair value gap, and you want to target a 1 to 3 risk to reward. You always want to target a 1 to 3 minimum. If you want to make your life easier in trading, trust me, you're going to want to target 1 to 3 for every single trade. So let me explain it again. Price tapped our area of interest. We've already identified the market trend, which is a bearish trend. We've identified our higher time frame key zone areas, which is this one right here. This is what I was waiting for. Once price tapped into this area, we got this rejection, leaving this imbalance, this fair value gap. And now, and then the last thing is we have to have a break of structure. At least one candle has to close below the previous low here, indicating that price wants to continue to the downside. So as you can see, let's see how this trade played out. We had another rejection here. We're starting to enter our fair value gap. Boom. Once we hit this area here, we would have gotten tapped in right there. Pretend like you got tapped in at that area. We would have put our stops above, take profit at our 1 to 3, and we'll just see what the market does. As you can see, price continues to the downside. and eventually hits our take profit. And that right there is the perfect entry confirmation, and why using fair value gaps can be very powerful, and you should implement it in your trading strategy, especially when it comes to entry confirmations. So let me go back over and let me explain the entry confirmations again. Step number one is you want to identify the trend. Where is price going on the higher time frame? In this case, the 1 hour or the 4 hour. Is it bullish or is it bearish? Once you identify what the market is doing and what the trend is, so let's say in this case it's bearish, that you move on to step two. Step two is identifying your key levels. What are your key levels on the higher time frame where price might react and continue to the direction of the trend? So that way you can zoom into the 5-minute time frame and look for your entry confirmation. Watch my support and resistance video under the market structure basics to learn how to identify those key areas. So once you identify the trend, identify the key areas, now when price taps into your key areas, you can look for these entry confirmations. But entry confirmation number one, did price tap my zone? Let's go back. Did price, oh, no, it's frozen. Okay, so did price tap my zone? Boom, yes it did. Did we get a rejection? In this case, it's a sell. So we're looking for a supply setup. So we're looking for bearish pressure. Did price create a rejection or bearish pressure or a supply setup? Did we get the three candle formations leaving a imbalance or a fair value gap? Yes, we did. We got 3 candlesticks and we left an imbalance here from this wick to this wick. Remember, it's always from the first candle to the third candle. There's a huge gap. There's a huge imbalance. There's a huge fair value gap. All right, entry confirmation number 3. Did we break the structure of the previous low? Technically, this is a change of character. I explained what change of character is on my market structure basics, but we broke the structure to the downside, indicating that this trade wants to continue going to the downside. That's literally the entry confirmations on the 5-minute time frame. All you got to do now is draw a box from your beginning to the end of your fair value gap. And what you want to do is you want to enter at the 50% line, put your stops at the swing high of the first candle that started the move, and then you're going to target a 1 to 3. If you do this and you just follow this simple trading strategy, you will be profitable. You will be profitable, but all you got to do is just follow it. Follow the plan. Follow the plan. And I promise you, every single time, well, not every single time, because obviously no one ever knows what's going to happen in the market, but you will be able to stack the odds in your favor, which is exactly what you want to do. Okay. If you're going for 1-to-1s in the market, your life is going to be very hard in trading, because that would mean that you would need above a 50% to be profitable. Oh, actually, you would need above, you would need a really high percentage. You would definitely need above 50%. With a 1 to 3 risk to reward out of 5 trades, you only need to win 2 trades to be profitable. So, I mean, I'd rather out of 5 trades only have to win twice. You know, if you win twice, you're up 6%, and then you take 3 losses, you're going to be up 3%. So it's better for you to do a risk reward to 1 to 3 or 1 to 4, minimum 1 to 3. 1 to 3 should be your minimum risk reward. Risk reward is the key to succeeding in trading. Yeah, that's pretty much it. Make sure you hit that subscribe button, like the video, leave your comments down below. Don't forget, check out the market structure basic playlist on my YouTube channel and join the free Discord. It's absolutely free. See you on the next video.